All roads lead to gold, ladies and gentlemen. It is a pleasure presenting here at the virtual World Gold Forum. Last year, I gave a keynote at the Denver Gold Show in Zurich and said that gold is back in a bull market. And once we go above this massive resistance zone at 1360 to 1380, this bull market will pick up momentum. Now, 1 year later, I'm absolutely certain that we will reach all-time highs also in US dollar terms. It's not a question of if, but a question of when. Ladies and gentlemen, my name is Ronald Peter Stöferle. I'm managing partner and fund manager at Incrementum, and together with my fabulous team, I am the author of the annual In Gold We Trust report. Ladies and gentlemen, traveling is forbidden these days, unfortunately, but let me take you on a journey where you will meet black swans, gray rhinos. You will learn more about firefighters and Franz Beckenbauer. We will talk about inflation and stagflation, and I will tell you what gold, the seventh sense of financial markets, is telling us at the moment. But now I would like to say a big thank you to our premium partners. As you know, ladies and gentlemen, the In Gold We Trust report is one of the most widely followed publications on gold and miners. The new gold report will be published on 27th of May, and we're already very, very excited about this edition because there's so much interesting stuff to write about, and we think that it's gonna be probably the best In Gold We Trust report ever written. At the moment, our fabulous team of 17 people is basically working 24/7 on the upcoming report. We are investing more than 17,000 hours of research, layouting, numbers crunching, proofreading and translating into this report. And it wouldn't be possible to put out this report that also wants to educate people and serious investors about gold, about the portfolio characteristics of gold, about mining stocks, and sound money. It wouldn't be possible to put that report out for free without the support of our premium partners. So thank you very much for helping us. There's still a few spots left for a premium partnership in 2020. So if you're interested, please let me know. Now, what will we be talking about today? We've got a pretty full agenda, and we will be talking about black swans and gray rhinos. I will ask the question, when trust in central bankers will start eroding. We will discuss what gold, the seventh sense of financial markets, is telling us. We will analyze the interplay between inflation and deflation, and if stagflation is a possible scenario going forward. And finally, we will talk about the golden future, because as I've said at the beginning, it seems that all roads lead to gold. The black swan that wasn't. What you see is likely to be less black swanish than what you do not see. That's a fabulous quote by Nassim Taleb, one of my most favorite thinkers. Ladies and gentlemen, are we using the wrong metaphor, the wrong animal metaphor when it comes to the coronavirus crisis? In recent weeks, headlines about COVID-19 have been full of experts describing the pandemic as a black swan. A metaphor for an extremely rare event that is unforeseen and that has an enormous impact. The term black swan was famously coined by Nassim Taleb in 2001, inspired by a 2nd century Roman poet who presumed that such birds didn't exist. And it has been applied to such disparate outliers like the 9/11 attacks. Since the coronavirus crisis was first reported by Chinese authorities to the World Health Organization, the term has been used extensively in stories. If you search Google News at the moment, you will find 180,000 results for black swan and coronavirus. But Nassim Taleb just said that there is no excuse for governments not to be prepared for something like this. The fact that Singapore has been praised for her defensive and precautionary actions against COVID-19 is testament to how this current pandemic is not a black swan. If we stick to the original concept, the proper metaphor for the corona crisis is a so-called grey rhino, which refers to a highly probable but neglected threat that have an enormous impact. It was coined by Michelle Wucker, a policy analyst who came up with the term after the 2012 Greek debt crisis. And then she published the book, The Grey Rhino, How to Recognize and Act on the Obvious Dangers We Ignore. Given what we know about pandemics and the increasing likelihood, outbreaks are highly probable and high impact. Wucker coined the term grey rhino for exactly such events like virus pandemics. Obvious, visible, coming right at you with large potential impact and highly probable consequences. Ladies and gentlemen, COVID-19 is not the black swan. Actions by politicians and central bankers and their impact on the real economy, businesses, wealth, our society and financial markets, that's the black swan. Now, let's talk about the last couple of weeks. We've been writing history. It feels like a combination of the stock market crash in 1987, the Great Depression, SARS, and the great financial crisis of 2008 and 2009. Actually, we didn't see only one shock, we saw a number of shocks. We saw a demand shock, a supply shock, an oil shock, a wealth shock. 17 trillion US dollars of wealth were basically imploding in the last couple of weeks. We saw a dollar shock and we saw a deflationary shock. So from our point of view, COVID-19 is only the straw that broke the camel's back, a very, very big straw. But beforehand, we already saw very, very dark clouds in financial markets. Ladies and gentlemen, if you follow our research and our presentations, you know that we've been warning about the recessionary clouds already for quite a while. Have a look at the yield curve. The yield curve is probably one of the most reliable recession indicators. It was screaming red, it was flashing red already last year. So the situation was already quite fragile before. Have a look at the everything bubble, a bug in search of a windshield. We should not forget that in the last couple of years, we saw not only a bubble in certain areas of the market, but we saw all-time highs in real estate all over the globe. We saw all-time highs in equity markets, in the art market, in many real assets, but also, and that's probably the biggest bubble, in bond markets. Now, financial market participants have been conditioned like Pavlovian dogs that every time the markets correct a bit, central bankers will come to the rescue. From my point of view, one of the biggest bubbles out there that still exists is the trust in central bankers. And this trust in central bankers is tested at the moment. Let's have a look at the question when the trust in central banks will start eroding. Paul Tudor Jones brilliantly said, "We've counteracted this existential shock with the greatest fiscal and monetary bazooka." It's not even a bazooka, it's more like a nuclear bomb. Ladies and gentlemen, at the moment we're seeing unprecedented monetary and fiscal stimulus. PEP, CPFF, and so on. The more acronyms used, the worse the crisis. Just to put the huge numbers of monetary stimulus into perspective, just last week, 550 billion US dollars were printed by the Federal Reserve. To compare, that's 5 times annual gold production or 4.5 times entire market cap of Bitcoin. If we compare the current situation to the great financial crisis, We did in 2 weeks what it took the Fed 8 months to do in 2009. Here we've got $1 trillion in 2 weeks. By May already, we will have, at this rate, have purchased what took us 6 years to do in the great financial crisis. But it's not only monetary stimulus, ladies and gentlemen. It is also fiscal stimulus. And we will see a much closer alignment and cooperation between central banks and politicians implementing fiscal stimulus. So it is unlimited QE, and it is also basically unprecedented fiscal stimulus. So far, in the last couple of weeks, 9 trillion were guaranteed as fiscal stimulus. To put it in perspective again, you could roughly buy all the gold that was ever produced for this amount. That's 10% of world GDP. Don't get me wrong, that's a big number, but this number will get much, much bigger because every economist who still believes that it's going to be a V-shaped recovery, I think will be proven to be quite wrong. I don't expect a V-shaped recovery. We haven't seen any major problems, any major bankruptcies so far. And with the time lag, I'm absolutely certain that problems will arise, and problems that central bankers and politicians cannot solve. And this reminds me very much of the situation in 2008. But the big difference is this time, central bank policy has been much more aggressive and much quicker, and fiscal stimulus was also much more aggressive than in 2008. Let's have a look at this chart. It shows us US inflation expectations and the gold price. And as you can see, in 2008, we saw a collapse of inflation expectations. Pretty similar to what we've seen in the last couple of days. And we also see that with the lows in those inflation expectations, gold put in a bottom. So from my point of view, we probably have already seen the lows in inflation expectations, and therefore I think that gold will not go any lower. I think for this trend, for this bull market, gold has probably already put in its lows. Now, why is inflation expectations, why is it that important for central bankers and politicians? Let's have a look at this chart. Ladies and gentlemen, you know that with Incrementum, we really like long-term charts. And what you can see here is a chart basically since the 18th century where we analyzed the deflationary and inflationary environment. And you can see until 1913, basically most of the time we had deflation and inflation. It basically changed quite often. In 43% of all years, we had deflationary environments. And then it changed. Actually, since 1971, we only had one very, very short phase with deflation. And that was in 2008. Now, why is it that important to understand that deflation is, from a systemic point of view, not to be allowed? In a highly leveraged world, ladies and gentlemen, price deflation from an economic and political viewpoint is a horror scenario that has to be averted whatever it takes, due to the following reasons. First, deleveraging leads to consumer price deflation, asset price deflation. Tax revenues decline. Asset price inflation can be taxed. Asset price deflation cannot be taxed. Falling prices result in a real appreciation of nominal denominated debt. So increasing amounts of debt can therefore no longer be serviced. In an over-indebted world, debt liquidation, price deflation have fatal consequences for large parts of the banking system. And fourth, central banks also have the mandate to guarantee financial market stability and to make sure it, like Ben Bernanke famously wrote, it doesn't happen here again. So, ladies and gentlemen, we should be certain that this time central bankers will do, again, whatever it takes to avoid any deflationary pressure. And as Stephen Poloz, the governor of the Bank of Canada, just said, I love this comment, a firefighter has never been criticized for using too much water. So in doubt, they will use way too much water, way too much monetary stimulus. But now let's talk about gold. What is the seventh sense of financial markets telling us? Ladies and gentlemen, you might have seen my previous keynote presentations where I said that gold is something like the seventh sense of financial markets. Now it's obvious what the first five senses are. The sixth sense is so-called extrasensory perception, the ability to obtain information without the use of normal sensory channels. In German, it would be Körpersinn. And the seventh sense is something like gut feeling, intuition about the future. And we've written a couple of thousand pages about gold. We researched the topic. And for me, it's still very, very fascinating. And I know, I don't claim that I understand gold, but I know that gold discounts lots of information. And therefore, the breakout in gold that we saw last year was already quite telling. Now let's have a look at this chart, where we compare the price of gold to the VIX, the volatility index, in 2008. Ladies and gentlemen, historically speaking, market crashes like this occur in three stages. Panic selling is the first stage. I think we already saw that. Then a relief rally of the lows. Technicians call it a dead cat bounce. And then the third stage is a demoralizing retest of the panic lows on supporting evidence such as terrible earnings or defaults. I think we're still in the second stage. So I think the really, really bad macro and economic news will come out in the next couple of weeks. We will see defaults in the corporate space. And this will be another test of the lows probably. Now, if we have a look at the gold price in 2008 and the VIX index, you can see that there were actually two spikes. And on every spike, gold went slightly lower. So in those moments of panic, gold is being sold off. Because gold is highly liquid, it is sold because market participants during those panic moments need liquidity. And those are also moments where actually deflationary pressure is quite strong. And what you can see here is that currently we are seeing the highs in the volatility index also marked the lows in the price of gold. And from my point of view, we might see another spike in the VIX, but I think the lows in the price of gold, they're already in. Let's have a look at this chart. You know this table, it actually shows the yearly performance of gold in various currencies. You can see that in 2019, gold was up in every currency. It wasn't only up in euro terms, in Australian dollar terms, in Canadian dollar terms, where it also made new all-time highs. It was also up in dollar terms. And this was the beginning of this big shift in market sentiment. So at the moment, the dollar is quite strong and the price of gold is also rising. That's a very, very good sign. And what you can see on this slide is a perfect confirmation that offense wins games, but defense wins championships. It shows gold in local currency versus the domestic stock indices year to date 2020. And what you can see is gold did exactly what it's supposed to do. It stabilized your portfolio. It was a good hedge against crashing equities. And that's exactly what gold should do. So gold is some sort of the Franz Beckenbauer of your portfolio. It's a solid and trustworthy defender, but it's also able to score goals. And from my point of view, pension funds and many institutional players are rediscovering the portfolio characteristics of gold at the moment. And this is something that will be quite important for supply-demand picture in the next couple of years. So gold is being rediscovered as a portfolio stabilizer. Let's have a look at the relative strength of gold versus the equity markets. And you can see that since 2011, basically, gold was underperforming equity markets. Fourth quarter 2018, remember, ladies and gentlemen, that was a quarter when basically every asset class was down. Gold was up 7%, mining stocks were up 17% in fourth quarter 2018. That was the moment when gold really reappeared on the radar screens of many investors. And now you can see that gold is actually outperforming stocks again. And normally those trends take quite a long time. So it might really be a secular trend of gold outperforming the stock market. Now the big question is inflation, deflation, or perhaps stagflation. The two main risk factors for the average portfolio are less than expected growth and more than expected inflation. That's a fabulous quote by Ray Dalio. And let's have a look at the perhaps ultimate contrarian call. Ladies and gentlemen, last year, it might be anecdotal evidence, but we saw that Bloomberg Business Week, but also The Economist, had the death or the end of inflation on their front pages. And as you know, we don't really care about inflation statistics because they only look in the rearview mirror. Therefore, we created our own proprietary inflation signal because we want to look through the windshield. So our inflation indicator is telling us when to play offense and when to play defense. We got a full inflation signal last year. So we went to a pretty strong allocation in inflation sensitive assets. A couple of weeks ago, we got a deflation signal, and now it really seems that inflation might really be around the corner again. So our signal is probably very close to turning up to inflation again. Now, people ask, how can inflation reappear? Ladies and gentlemen, we should not forget that the enormous amount of money creation will unlikely have an effect or an inflationary impact at first instance, as the lockdown of the economy means that velocity has totally collapsed. But when the lockdown ends and the recovery begins, there will be a much, much greater stock of money in the system, which will at some point likely have inflationary impacts back when velocity and business life returns to normal levels. So from our point of view, inflation is definitely more than a tail risk. But let's have a look at this chart. It's showing us the amount of debt, the amount of bonds with negative yields. So that's, if you hold it until maturity, that's a guaranteed loss. At the moment, this number of negative yielding bonds is at 14 trillion. That's, to put this number into perspective, that's the combined economic output of Germany, Japan, India, and Great Britain. So it's not peanuts. Now, if inflation might become a concern for financial markets, where will the money flow to out of those bonds? Will it go into equities? Perhaps. Will it go into real estate? Perhaps. But I think that gold, which has impressively proven over the past centuries that it's a perfect hedge against rising inflation, I think that gold will be one of the biggest beneficiaries of those flows. Now, the big question is, which sectors are the biggest beneficiaries in times of rising inflation? Obviously, bonds are not the best idea in general in times of rising inflation. But people tend to forget that equities also have a hard time in times of rising inflation. So, ladies and gentlemen, you have to be really sure that the companies that you hold have got pricing power. Stocks in general are not a good inflation hedge. It depends on the sector. Of course, the best inflation hedges are mining equities, gold, precious metals in general, and commodities. So if you think that inflation is more than a tail risk, you should own some inflation protection in those inflation sensitive assets. And we tend to forget, ladies and gentlemen, most investment advisors in our industry are very experienced. So the average investment advisor at the moment is 52 years old. So he was born in 1968 and did not really actively experience the stagflation of the 1970s as an investor. Since 1980, we saw the biggest bond bull market in history. Bonds have always hedged stocks, so the correlation has worked. What we will experience in the future will be new for those very experienced investment advisors. And ladies and gentlemen, I think that stagflation might be really a scenario that we might see in the next couple of years. So how does gold perform during recessions? In our last In Gold We Trust report, we actually analyzed the performance of gold, but also equities during the various stages of a recession. Now, what are those 4 stages? The first phase is the run up. So that's 1 quarter before the recession hits. The second phase is the unofficial recession. So the period from the outbreak of the recession to the official release of the GDP growth figures by the statistics office. The third phase is the official recession, and the fourth phase is the last quarter of the recession. I think that at the moment we're still in the second phase and we'll move to the third stage in the next couple of weeks. And as you can see on this slide, that should be a very positive environment for gold. And ladies and gentlemen, we crunched the numbers in our previous reports, and actually gold is one of the best stagflation hedges. Now, let's talk about mining stocks. In a bull market, the sidelines is the worst place to be. Michael Kosaris said that, and from my point of view, mining stocks are in a bull market again. Many people compare the current situation to the Great Depression, and of course, we all know that we were on a gold standard back then, but the Gold Reserve Act of 1933 under Teddy Roosevelt, at the height of the Great Depression, where gold was revalued from $20 to $35 an ounce, or we could also say that the dollar was devalued against gold, we can say that actually mining stocks did tremendously well. Have a look at the performance of homestake mining as a proxy for gold during that environment. One of the very, very best environments during the Great Depression. But let's have a look at the current valuation of the mining space. What you can see on this chart is the Barron's Gold Mining Index, the BGMI, versus gold. So a ratio that basically tells you how cheap mining stocks are relative to gold itself. We're on the same levels basically like in the year 2016 when the lows in gold were in and the lows in the mining space. And since then, we have never been at a lower level. So we can definitely say that relative to gold, mining stocks are dirt cheap. And from my point of view, this party only has started. You know this chart probably. It shows the bull markets in the Barron's Gold Mining Index, the BGMI, since the year 1942. So you can see that the current uptrend is still relatively weak compared to its predecessors. So should we actually be at the beginning of a pronounced uptrend in precious metal stocks, which we assume to be the case, there remains plenty of upside potential. And it also shows you that every bull market ends in a parabolic upward spike that normally takes 9 to 12 months. We haven't seen this mania stage yet. So, ladies and gentlemen, just from a fundamental point of view, we should be certain that the Q1 numbers in the mining space should be pretty good. We've seen that gold prices were on average 12% higher than last year. And we saw that actually oil prices, which are one of the biggest input costs, were significantly lower. So we should expect pretty good announcement, pretty good earnings in the first quarter. And technically, I think there's very, very few sectors where you can see that most stocks are trading above their 200-day moving average. And actually some stocks are making new all-time highs. So I think miners will come into the spotlight of capital markets again. Now we're coming to our final chapter, the golden future. Bull markets are more fun than bear markets. I think everybody in the gold industry knows and understands that. So we really look forward to this bull market, hopefully. Let's have a look at a chart that I presented already last year. Last year I said that we will be in the second stage, in the public participation phase, as soon as we go above this resistance at 1360, 1380. Now, let me describe those three phases that are based on a so-called Dow theory. They both take part in an uptrend and a downtrend. Now, let's consider a bullish market. The first stage is the accumulation phase. It represents informed buying by the most knowledgeable and contrarian investors who believe that all pessimistic information has its reflection in the prices and the turning point is near. We've probably seen that from 2016 until 2018. The second stage, which is the longest, is the public participation phase, where most trend-following investors enter the market. Prices start to rise rapidly in this phase and the news become more optimistic and analysts raise their price forecasts. Ladies and gentlemen, I think we're like in the first third of this public participation phase. So every dip should probably be bought. And the third stage is the distribution phase. It's connected with the third wave of investors, the general public that begins to buy on the presumption that the current trend will continue forever. In this phase, the very same informed investors who began buying in the first place begin to sell before anyone else starts. So, ladies and gentlemen, we are in this public participation phase. And I think that, as I've said, every dip should be bought and we should ride this bull market. Now, let's have a look at the decisions that generalists have taken recently. We can see that actually ETF holdings in the gold space as a percentage of total US market cap, it has been quite stable over the last couple of years, but at a very, very low level. Now we have seen some sort of a breakout, but we're still at ridiculous levels. From my point of view, gold will go mainstream even for generalists and institutional players. I think this is a trend that currently is starting, like I said at the beginning. So expect more inflows into ETFs. Now, ladies and gentlemen, have a look at this chart. It was, I think, originally prepared by the great Pierre Lassonde. So many thanks for this fantastic idea. It basically shows the trajectory of the price of gold over the next couple of years. If we perform, like, for example, with the same growth rate like 2000. So basically gold will trade above $4,000 then in 2030. If we trade with the same performance, annual performance like in 1971, we will trade at $3,400 or with the same growth rates like since 1990. Then we would be trading at 2,520 at the end of this decade. Now, ladies and gentlemen, I know this is a very simplistic view, but from my point of view, this growth rate is basically not a coincidence. Gold is a great hedge against monetary inflation. Therefore, since 1971, we crunched the numbers, and monetary inflation is roughly 8%. Therefore, you can see that gold hedges this monetary inflation. It preserves your purchasing power, and that's basically the job that gold should be doing. Now let's have a look at commodity markets. That's one of the most copied charts that we ever produced, and actually the honors should go to our friend Thorsten Lenin, who first created this chart. It shows a ratio between the Goldman Sachs Commodity Index and the S&P 500. And you can see that relative to the stock markets, commodities are extremely undervalued. So normally, I would say that mean reversion is an important and iron law of financial markets. We are way below the means or the median, and we are even more below the highs. And normally, those moves coincide with tops and bottoms in the US dollar. So if you think that the US dollar will go lower, probably commodities would be a pretty good idea, because we're actually trading at even lower relative levels than in the 1970s. Now, why should commodities go higher? Remember my slide about fiscal stimulus. Expect very aggressive infrastructure programs. And I don't think that commodities, that are probably the most hated asset class at the moment, that they will underperform in such an environment. Now, if you like gold, then you should also like silver at the moment. As I told you, we really like long-term charts, and here you can see a 300-year ratio between gold and silver. Since 1718, silver has never been cheaper relative to gold. So if you expect a bull market in gold, then you should probably also consider buying some silver, which is probably much more contrarian than gold and commodities at the moment. Now we're already coming to the end of my keynote. What are our core views? Welcome to the mother of all stimulus. Ladies and gentlemen, we should expect more aggressive QE, negative interest rates, MMT, QE for the people, universal basic income, you name it. But this time, fiscal stimulus will be much, much more important than in previous crises. After the corona crisis comes the debt crisis. Rising price inflation is, from our point of view, much more than a tail risk. Those extreme measures that central bankers have taken might lead to a loss of confidence in monetary policy. Mining stocks and commodities will be huge beneficiaries of monetary and fiscal policies. And, ladies and gentlemen, gold is back in a bull market. Gold, and probably also Bitcoin, which is also not inflatable, are on the way to new all-time highs. It's not a question of if, but rather of when. So thank you very much for your interest. Thank you for the gift of 30 minutes.